questions, just interrupt me, whatever. If I don't make sense, feel free to interrupt me. Tell me that. Tell me what, if you want to hear something different. But Chris and Paul sent me a bunch of questions that people had sent in, and so I'm hopefully going to answer a bunch of these questions. And I love charts. I know they're not always the greatest, but I do like charts, and so I've tried to put in a few charts that hopefully it'll help answer some of the questions that people have. And then I will talk about the general market a little bit as well. And for those of you who don't know me, my name is Troy Patton. I'm a CPA. My CPA stands for Cut, Paste, and Assemble. Unlike these guys, I do investing and business valuation work. Don't do any tax work or accounting work any longer. Just investing and asset management. So some of the questions are, and again, I'll try to hit on these, and then I want to make sure that I answer all the questions that everybody sent in. But if you have a goal of investing $25,000 per year at age 50, and you can only put in a small amount in an IRA, where do you invest the rest? And then at the same time, how does an investment really multiply? And the reason I put both of these together is, so if you can only put into an IRA and you can only put in $6,500, you need to invest the rest elsewhere. Some of it's going to be tax deferred, some of it's going to be in a regular account. So the one thing I did here, and this is actually goes to another question as well. It's going to answer kind of three questions at once. But when you invest, obviously the amount that goes into a tax deferred amount, it continues to multiply because it'll multiply quicker because there's no tax on the dividends and interest that's earned. Okay, so if I start out with $100 and I made $4 in dividends and interest, and I had to pay tax on that. So let's say I had to pay $1. I have $103 then to invest the next year. If it's in an IRA, the whole 104 is invested, and so on. And it's what I did here because one of the questions was, if I start at this age, and what if I start late? There's some different questions like that. So it's what I did here is I said, consistent Chloe invests from ages 25 to 65, earning 6%, and she puts in $200,000. Quitter Quincy invests from ages 25 to 35. Everybody's earning 6%, so he puts in $50,000, just from 25 to 35, and stops. Okay. Late Lydia invests from ages 35 to 65, so she puts in $150,000. And then Nervous Noah saves from ages 25 to 65, but it leaves it all in short-term bonds or cash and earns 2%. Okay. So Nervous Noah, at the age of 65, earns has $308,000, even though he put in $200,000. And Quitter Quincy, you might think, wow, this guy, he's not going to do very well because he only put in $50,000. But if he earns 6%, he actually gets all the way to $401,230. So the whole idea here is to start early, right? And Late Lydia, even though she invests from 35 to 65, which is 30 years, $150,000. Come on in.
Excuse me.
No, you're fine.
Thank you, pardon.
Earning 6%. Late Lydia has $419,000. Okay? So really, I mean, just the moral of the story is to start early. Now, not everybody can start early, obviously. And if that's the case, then we need it's better to invest later than not at all, obviously. But it's just the compounding of money over time. Okay, saving early and often and investing what you save are some of the keys to a successful retirement due to the compounding of the dollar. Just like I said, the $100 put in, if it earned $4 in an IRA versus outside of an IRA. Now, the one thing that I do not have a chart on, but I do want to just mention briefly is if tax efficient investing is also important to us. So if you aren't investing in an IRA and you're just saving outside of an IRA, you should probably invest in something that's a little more tax efficient. Maybe something that isn't churning capital gains and actually I like dividends, but huge capital gains and all dividends all the time. Because the growth in principal is also important. So for instance, everybody here have an iPhone?
No.
No? You have any kind of, you have Samsung or? You have a smartphone?
Flip phone.
Flip phone. You are awesome.
I'm
Wow.
on purpose a Luddite.
I'm getting a picture with that later.
Okay.
Okay.
The Wonder Woman male star, Chris Pine, also has a flip phone.
I love flip phones, actually. I give them to my kids when when they get in trouble with their iPhone. I give them the flip phone. I said, figure this one out for a while. So it's actually a big joke in our house. So just like Apple's stock, they're talking about it now being worth $1 trillion. It's almost worth $1 trillion. But if you looked back a year ago, it was only worth about $700 billion, right? I know, only. But that's growth in the principal, okay? Apple at the same time has paid dividends, but the growth in the principal is the tax efficient part, okay? It'd be no different than your home being worth, back in Indiana it's a lot less, but here 300,000 to growing to 500,000. That's appreciation of principal, okay? And there are some stocks that are focused on just the capital appreciation of principal, and some that are focused on paying out dividends, okay? The next question, how much should I save if I plan to retire at a certain given age? There's a lot of questions like this, okay? So this is really tough because everybody has a different spending habits in retirement. Some people are going to want to travel. Some people are happy keeping bees or having a garden at home, like Paul. He's going to work in his garden, someday, and he's not going to travel. So here's different savings rates, okay? It's 7 to 17%, and this is a really tough chart to understand, to be quite honest. But basically, the crux of it is that if you want to live on $500,000 a year and you make $500,000 a year now, you're going to have to save a heck of a lot. Okay, it only goes up to 300,000, right? And it's 76. And if you wait to the age of 50 to start investing, it's 76 times 300,000. That's a lot. I can't even do the math. Okay, so that's one of the things that I would tell everyone is if you have a 401k, even before investing with us or anybody else, invest in your 401k and max out your 401k or IRA. That's the first place you need to invest, especially if you have a company match. Okay. Question number, or actually, that's the third question. How do I invest in a market that may tank? Should I pull money out as it continues to grow and leave the original amount invested? Okay. People ask us this all the time. When is the market going to tank? When's it going to fall apart? I have no idea. I really don't. But I will tell you this, that, and actually I was listening to CNBC on my way in, and people were talking about the first part of the bull market, of the market going up, has already started. Now we're into the second phase, and that second phase is going to last a long time, and then we're going to be in the third phase. Forget what everybody says. The market is going to go up until it doesn't. And it's going to go up until it doesn't because of a couple things. One, it could be North Korea, all right? You never know, right? There could be some other geopolitical event. Maybe they impeach Trump and the market drops 10% tomorrow. Who knows, right? I'm not saying that's going to happen. I'm not saying it's probably likely. I don't think either of those scenarios are likely, all right? I would tell you this, everybody's been focused on this new tax bill here in Washington. And even though I'm in Indiana, I read about it every day, and I'm focused on it too, because I do think that the market right now has gone up in anticipation of the tax bill or some tax reform being passed. Now, I don't know, Paul and I were talking a little bit this morning, we were talking about the estate taxes. And Paul said, well, I don't think that'll probably pass that part of it, and it may not. But if some form of tax reform passes, I think the market will continue to move higher. And I do think, although Washington is going to spend a lot of money, no matter who's in office, right? It doesn't matter to me. I can care less if it's Republican or Democrat or anybody else. They're going to spend a lot of money. And the truth is, the more they spend, the higher the market's going to go. That's just it. That's the bottom line. And you say, well, gosh, we've spent a lot. Maybe it's going to tank because interest rates are going to rise. The problem is the interest rates are not going to rise right now. And this is something I was wrong about early on. I'm happy to admit it, or I'm not happy to admit it, but I'm free to admit it, is that when the government started printing money years ago, with the quantitative easing, if everybody's heard that term, the QE, and where they pumped billions and billions of dollars into the economy, what had happened is the Federal Reserve here, their balance sheet expanded. And now they're going to try to unwind that. In fact, they started last month. They retired, I think it was $8 billion in investments, which isn't a lot. They want to get to 60 to 80 billion, possibly per month. But I think that's actually the biggest risk to the market right now, is them taking the dollars out of the market and not buying the debt. And the reason I say that is because the reason they did it is because they created a ton of liquidity in the market, meaning there was a lot of cash moving around, lots of cash, okay, moving around. And right now, I don't think there's quite as much, or there won't be as much when they start reducing that. With that being said, here's a great chart. I mean, the market has tons of ups and downs. We have the Great Depression, World War II, the Korean War, Vietnam War, stagflation, the Reagan era, Black Monday, end of the Cold War, the tech boom and bust, the global financial crisis. Look how small that global financial crisis looks today. And then where we're at right here. So this is what I would tell you. Since 1924, there's been more than 115 10% downturns in the market. That means more than one a year, okay? And they average 18%. If you've come and listened to me before, I always say the United States is undefeated in comebacks, and next time will be no different, right? I mean, they're just mere blips in the scheme of things in long-term investing, okay? And one question that's not on here that I do like to always bring up is a lot of people say, well, if I'm entering retirement, don't I want to be more conservative? The truth is, on the day you retire, you're not going to pull all your money out and spend it that day. I mean, people are living a long time. I mean, you could be in retirement from age 65 to 100. And who knows what our generation right here, everybody sitting in this room, is going to live to. I mean, there's the drugs that are being created. I mean, it's not the recreational ones, like in Colorado, right? But the real ones. I mean, we're living longer. It's a fact. And I really believe if we came back in 15 years, we would see this line be right up here. I think that's where we're headed. I mean, it's hard. It's real. Somebody's gonna have a tough time convincing me right now that the economy's in trouble. It's not. People are spending money. Okay. Are we good, Raj? Okay. The next one: how to determine and balance my risk profile. As an entrepreneur, I'm optimistic about the future and spend much less time worrying about my own welfare as opposed to the companies I manage. I need to have a system that advises and assists in managing that risk, but requires little of my constant direction. Come on in.
Yes, thank you.
Yeah, no problem. So this question was on here last time, but I just want to answer it again. Okay. There's some things that you can control, and there's some things that you can't control. Okay. So the one things that you can control is asset allocation and your saving and spending. Okay? And what I mean by asset allocation is stocks, bonds, slow and steady wins the race. Not every investment has to be in Apple or Google or Tesla or Amazon. Right? Amazon, I'm telling you, they are not going to take over the world. I'm sure of it. Okay? I'm pretty sure, anyways. So they're going to try, but it's not going to happen. All right? And you have total control over the saving and spending. So the question being, how do I invest? I mean, if I'm, how am I? Well, the things that are out of your control are the market returns and policy regarding taxes, savings, and benefits, right? So you have some control over the longevity. Do you eat well? Do you exercise? Do you go see the doctor? And your employment earnings and duration, obviously you have some control over that. So this we have no control over. This we have some. So this is what you need to focus on. as individual investors, asset allocation, where we're investing. We're going to have some stocks, we're going to have some foreign, we're going to have some small companies that we're going to invest in, and then our saving versus spending. Oh, you're fine, Quinn. Hold on. So I always like this chart because I think it always kind of puts it all into perspective about retirement and what we can control and what we can't control. And I think hopefully that answers that question. Here's the next one. Paul, my biggest question would be, is there a benefit in the long run in picking individual stocks, or after all is said and done, just buying up various funds that are a variety of classes a better way to go? This was also on here last time, but it's also, there's a similar question on here this time. And again, it's what I would tell you is you have to diversify. Everybody thinks they're aggressive until the market gets aggressive with them, right? And that's normal. I mean, you guys were all pulling for the Washington Nationals this year, right? No? The Baltimore Orioles?
Tigers.
Okay. Oh, okay. Well, that's really bad. I'm sorry. After Verlander left, I don't think there was any hope left. So, okay, but the Washington Nationals, I mean, you finally had a pretty good year, and a lot of people started following the Nationals. But the truth is, 8 years ago or 7 years ago when they were horrible, I guess I'm pretty sure none of you even probably knew who their starting pitchers were or anybody that played for them. Right? No. But now that they're doing well, or they did well, it's, hey, guess what? They just got a new manager, et cetera, et cetera. The stock market's no different. We all want to invest in things that are going great. Hey, I want to be in Amazon, but 10 years ago, right? So everybody piles into Amazon today, and then maybe it falls apart. So the whole idea is don't just like the Detroit Tigers, but like the Nationals also, and the Baltimore Orioles. Throw the Cubs in there every once in a while. Have about 5 teams you like, and you'll have a better chance that one of them makes it into the playoffs and actually goes farther, right? That's the whole idea. My son always tells me he likes the Cubs, right? I'm a Cincinnati Reds fan. The Reds are horrible. Have been for years. There's been a few years. But I told my son, I'm going to start liking the Cubs also, so at least I have one team to root for in the postseason. Investing's no different, right? Okay. What is the most tax advantageous system for withdrawing funds during retirement? This is a big question that everybody always asks. Okay, and this is what I want to show you. So, in fact, one of our CPAs out west had a client that they just invested some money with us, and they said, this is what we want. We want to invest $1 million, and we want to be able to withdraw 7.5% a year, all through retirement. And the first thing I told them was, I said, don't expect it to last long, and you better hope that the market rises right away, right? And the reason is because even though it's very possible to get an average of 7.5% over time, if the market falters right at the start when you invest, you're going to have a really tough time meeting those demands. So, is what we try to tell people is, if you had $1 million and you invest and you withdrew 4%, your probability that lasts all the way through retirement. And again, remember I just said we're all living longer. I mean, it's going to last quite a while. If it's 5%, and this is a 40-60 portfolio, 40% stock, 60% bonds, then it's going to last about 27 years. And if I withdrew at 6%, it's going to last about 22 years. Now, if I take that same 4% and I do 60% stocks and 40% bonds, and 40-60 and 20-80, you can also see how, and 100% cash, how that money disappears over time. Again, you're living longer. You need to invest in stocks, even in retirement. I mean, unless you just have, $50 million and you want to call it a day and invest in municipal bonds, and I think at that point that's probably a good idea. You call it a day, ladder bonds out, and just live off the interest. But not everybody probably has $50 million, right? So, all right.
But if you have a pension, and you only need to add a little bit to it, would that apply?
Oh, that's awesome. That's even better. So if you have a pension,
Not quite enough.
yeah, and that way you can just withdraw a little bit out of your 401k or your savings each time to supplement your pension.
So how aggressive would you be with your savings?
Well, everybody's different, but I will tell you this. So I'm 48 years old, 48, 49ish, whatever, I'm right around there. So I forget every now and then. But I invest moderately, and I always have, which means I'm 60% stocks and 40% bonds. I've done it forever because I believe in slow and steady wins the race. As opposed to even when I was 30 years old, I didn't invest in all stocks because I want to be able to go to sleep at night and wake up the next morning and say, hey, look, my investments are still there, right? I mean, and not have to worry about it. And so to answer your question specifically, I don't know what your risk is. Maybe you're a risky person, maybe you're not. I'm not really sure. But if whatever the case may be, whatever that amount that will make up the shortfall in living expenses, you could sit down with Paul or Chris or whomever, and they could probably help you figure it out. And so maybe you don't need to even be moderate. Maybe you can be under moderate because you have enough in assets that you don't need to take more risk. Okay? So, I don't know if that answers it very well, but okay. How can one avoid the temptation to hop around and follow the latest fad? Well, this is an unbelievable chart to even imagine to look at, right? So this is what I'm going to tell you. There's times when stocks do well, and there's times when bonds do well, right? And sometimes bonds do better than stocks, and sometimes stocks do better than bonds. And sometimes foreign companies do better than domestic companies. And sometimes foreign bonds do better than domestic bonds. So investing across all different kinds of investments is important, all right? And having things spread out. Again, same thing with the baseball team, or now we're in basketball season. Who's your basketball team?
Oh, heavens. You're kidding.
Indiana.
He is. No, he is.
Pacers.
The Indiana Pacers. That's who you should follow, right?
Yeah, right. Never heard of him.
Me neither, actually. Okay. So, how do we plan for the near future and the extended future with all the turmoil in the world today? All right.
You don't.
Yeah. You know what? You really just have to stay invested over time. This is a true story. In 08, 09, when the market had fallen from 1,500 and it was down to 815, so almost in half, I called all the clients and put out an alert and said, everybody should get fully invested. And everybody's like, you're crazy. And I said, I'm telling you, you should get fully invested. We were in what's called the bottom 10th decile of investing. That means the cheapest the market has ever been. We were actually in the four percentile of investing. The market dropped to 667, and I had people calling me telling me that I was crazy. He said, everything's going. They said, Troy, it's going to fall apart. I said, it can't fall apart that much. I mean, it just can't. I said, if it does, your money's going to be worthless anyways, right? And sure enough, I mean, hindsight's 20/20. But I mean, I'm not the great Karnak, but at the same time, I'm not a, you know, I can't see into the future. But I can tell you this: the Gulf War came and went. All right, the Asian market crisis came and went. The September 11th attacks, unfortunately, you know, I mean, it came and went. And just to tell you, I mean, I will throw in one story on this. I was actually at the second tower the day before it got hit, and my wife was pregnant with our first child. This is all the women. Women are so awesome. I gotta tell you, right? So, but we're in the lobby of we're staying at the Marriott World Trade Center, and we watched the Colts and Jets play on Sunday, and I was there visiting some people for work. And we're going through the lobby, and my wife says, we got to go home. And I said, really? She said, bad things happen here. I don't like it. This is a true story. I said, "Oh, you're overreacting." She goes, "No, I want to go home." We flew home, and that Tuesday it happened. Isn't that amazing? I mean, you can cut that part out of the thing. I mean, I'm telling you, she's
Clairvoyant.
it's mother's instinct, I guess, right? So, my point is that I mean, the crisis. There's going to be another one. We're going to have another crisis. I'm sure of it. I don't know when it is, but I mean, we're going to have another one. And then this is the chart that I love showing people because this is performance of $10,000 investment between January 1, 1997 and December 30th, 2016. Okay, remember we had some really bad times. The 2000, the dot-com crisis, September 11th, 08, 09. But for the last 20 years, if you invested $10,000 with a 7.68% return, you would have $43,000 today. That's better than a poke in the eye, right? Okay, but if you sat out, like let's say the market went down and you sat out and you missed the 10 best days, all right? And by the way, 6 of the best 10 days occurred within 2 weeks of the 10 worst days. All right? So the best day of 2015, August 26th, was the only 2 days after the worst day, August 24th. The market has a tendency to fall apart and come right back, and quickly.
Why?
I'm sorry?
Why?
Well, generally,
What bounces it back?
because people overreact on the downside, right? My wife has a sinus infection. She's calling me this morning as I'm driving here. Oh my gosh, it's really. I said, Kim, you know what? You're just going to go to the doctor and you're going to get drugs and it'll be better in 3 days, right? I mean, but she wants to worry about it all the way there. People do the same thing with investing. They don't want to get back in. It's going to keep falling apart. I'm worried. We just have to climb that wall of worry and jump right back in.
So what did you do in 2008?
I stayed invested. I didn't move one investment in my entire portfolio, not one, all the way down and all the way back up. And I have my statements. I invested in the Archer funds, my own site, cooking, and nothing changed for me. I mean, yes, it was a tough time, and there was we had to talk to a lot of people because people were worried, and rightfully so. Okay, and the people that were in retirement, some of them had to tighten their belts a bit. I mean, it's, but even if you were invested in bonds, I don't know if a lot of people know this, bonds actually dropped 27% during that same period of time. So just because you were in safe bonds, municipal bonds, Indiana has never had one default on a municipal bond, ever. But Indiana municipal bonds dropped 18% in 3 days in value. I mean, it was a good buying opportunity.
So it's all psychology.
I wish I should have been a psychologist, truthfully. Because
It's all
I'll give you
because
my
of people's
card.
behavior. The company is worth what it earns.
right,
The company is worth what it earns. The company doesn't change when the stock goes up or down. The company's still the same company. It still has the same. So the reason why you have changed the price is just people's behavior.
everybody trying to get out the door at the same
It's
time.
people's behavior that causes the change in price. But the company itself is still the same. Still has the same number of employees. Still does the same stuff.
Apple still sold iPhones.
It still does the same stuff. So actually, the value is the same.
Yeah.
It's just that because of people's behavior, it changes what happens on the price.
Yeah, did you know, a good example of that is Coca-Cola. They still sold the same amount of Coca-Cola during the 08-09 crisis. I mean, to me, pretty much the same, right? It's just that people were worried that Coca-Cola wasn't worth as much. So,
Right, it's just people. We have around here. We have Under Armour.
Okay.
Under Armour was
Yeah.
one time was probably in the 50s.
yeah,
And recently sales were down 5%.
Yeah.
Stock dropped
that's
30%, but still the same company. The company didn't change. It's
Right.
the same number of employees.
Yeah.
Still
Under Armour
the same
still
amount of money.
they still have a great brand.
Still the same.
Yeah.
You can't react to the price.
Yeah, it's kind of interesting. A guy in my office actually loves Under Armour right now. He thinks it's a great buy.
Who's that?
Steve Demas. He likes Under Armour because because he thinks he's like it's not going away. I mean, look at all the
He's a cool guy.
So, okay, this is, I think, this might have been from the last time, but what do you see as the future for passive investing? And I do want to mention this because, oops, I don't have a chart on that, because a lot of people talk about passive investing quite a bit. So passive investing is like an index, if you were to buy an index. And I think there are some merits to some index investing. But the one thing that I would be careful of is that even today,
What is index investing?
okay, sorry. So that's a good question. So index investing means you buy 500 stocks basically, and you never change. You only buy those 500 stocks, and you hold those 500 stocks forever and ever and ever and
You
ever.
buy S&P fund.
That would be the S&P 500.
500. It shows 500.
Right, and there's all kinds of different passive investing. Okay, the one thing that people really don't know is that passive investing is really truly not necessarily passive investing, and the reason is because the S&P 500 replaces stocks every year, so someone is watching that.
Percentage changes.
Probably 4%, maybe. Yeah, it's a small amount, but maybe a little bit more than that. But there are merits to it from a cost standpoint. But at the same time, there are still, if you're okay with being just below the average, then that's probably okay. I mean, if you're okay with that, because if you always do a passive investment, you will always perform just underneath the index. Okay? As an active investor, which is myself, I always like both. You hot? Okay.
I'm real hot.
Okay, sorry. But by active investing, 30% of all true actively managed mutual funds consistently outpace passive investing. If we expand that beyond, we can get to about 60% of active investments outpace passive investments. If we start talking about investment managers that invest in their own investments that they manage. So I still like active investing.
Where does it say that? What you just said?
Morningstar. Morningstar has that report out on the active versus passive.
Like you'll send that to us.
I've sent that to you.
Okay.
Yeah, about a year and a half, 2 years ago, or a year ago, whatever.
What that?
I'll have to look at it. But I guarantee you, I sent that article. Actually, we sent it out to everybody. It's a pretty good article.
How can clients get that?
Well, you can Google it actually. Like for instance, like Vanguard. People know who Vanguard is. I like Jack Bogle, but his latest book or his latest tour. His interview with Morningstar, I thought, was unbelievably self-serving. He said the market's only going to grow by 4% a year each year from now on. So you should only invest in things that don't cost money. Well, good luck then. If you want to take 4%, have at it. I'm pretty sure that we over the next 5 to 8 years will average somewhere around 8% to 10% in the market. In fact, I think the next 2 years are going to be pretty solid. So. I mean, there's some good articles. There's people that argue both ways. There are times when passive does beat active, and there's times when active beats passive. And there's a really good chart on Morningstar about that.
How about historically?
I'm sorry?
How about historically?
Well, passive investing has really been, for the last 20 to 25 years, has been more prevalent than active investing.
No, I mean, historically, it's better yield.
It's actually about the same if you look at the chart. There's times when active is beaten passive and passive is beaten active. So, and here's the one thing that you have to be careful of when we talk about passive and active. Some of the active managers are really passive managers.
Was it playing golf?
No. So everybody knows who American Funds is? Has everybody heard of American Funds?
Yes.
Okay, American Funds is actually passive investing.
But don't they charge large fees?
They charge active management fees.
But they don't do anything.
It's all passive. In fact, not one of their managers. Again, Morningstar is full of information. Not one of their managers actually invests in their own funds that they manage.
Well, they're not allowed to.
No, they are.
They don't trust them.
It's passive. They're passive funds. That's why they don't have high turnover. They still have expense ratios of 0.7% or 0.6%, but they're actually passive funds. People just don't know that. So if you remove all the people that are actively passive, yeah, I know it. If you remove those people, the active managers actually perform better than what you think. And that's what people don't know. And I hear it all the time. Well, passive beats this. Well, passive's beating that fund. Well, that fund is really not active. So, I mean, you have to look at it over time.
So how do you pick the best active funds?
Well, that's what we do. I mean, we try to look at them. We try to say there's certain ETFs that we will invest in portfolios and certain mutual funds. And we try to look to see who's done what and who are the better ones. So, I'll just say this. So, for instance, like a foreign fund, like a Polaris Global Value Fund, they are active managers, but they have consistently there are times that they won't outpace their benchmark, but overall they do. And that's what we're looking for. We're just looking for people that outpace their benchmark over time. So, long term. Okay. Talking about what about foreign investments since foreign markets have done so well? So this is what I tell you. Foreign markets have done very well the last 18 months or 20 months, but they haven't always done well. In fact, I hate to be biased, but the United States is still the best place to invest. It really is. With that being said, China actually, it's not a good chart because it's going to be too hard to explain. This is better. So the average contribution to the global world products produced, the United States has dropped from 25% to 9%. So yeah, 1992 to 2000, and then 2010 to 2020 estimated. 25% to 9%. China has gone from 20% to 34%. I think this is a really good chart. Look at Asia, 43% to 62%. The reason I think this is a good chart, and people say, oh, well, I should be investing in China, I should be investing in Asia. You are, even though you don't know it. Apple sells iPhones in China. They sell iPhones in Asia. Intel, Coca-Cola, Pepsi. You actually invest internationally. Companies now do business internationally. So even though you may have a lot of domestic or United States companies, you are probably invested overseas more than you believe. In fact, we were talking about the S&P 500, the top 500 companies in the world today. Actually, I think it's 63% of all their revenues come from overseas. As where if we look back 20 years, I think that number was like 38%. So it's becoming more of a global.
So you go back to the question. Yeah. What's he talking about? He was talking about buying somebody on the China exchange.
Well, they're just saying they just said, what about foreign investments since foreign markets have done so well?
Troy, he may be talking about 12 months, foreign mutual funds have done quite well.
Yeah.
But isn't it true in 2008 that the foreign mutual funds actually did worse than U.S. mutual funds?
Yeah, they did.
And recovered a whole lot slower.
Yeah, in fact, some of them are not even back up to where they were.
Right.
Still.
So to me, that's not a really good track record of putting maybe some of your money, obviously, in some stocks like that, but if you think 12 months is going to change the rest of your life's focus on investments, I think you got to look at a larger scale.
Yeah, absolutely. There's a question, I think it's in here, it was on here, it alluded to basically investing in what's doing well, right? So if you always chase what's doing well, I can assure you will underperform over the next 10 years. And the reason is it's just the equilibrium of the market. It's what we call in our office, we talk about it all the time, it's called reversion to the mean. Yeah. All right? Everybody in this room, it's all reversion to the mean. If I take water and I put it in two different places, it's going to smooth out. It's always going to find its equilibrium, right? If I put a hole between two glasses and it was connected, they're both going to find their way. Sometimes they're going to underperform, sometimes they're going to overperform. That's why it's good to diversify and have different investments. Some foreign, we believe in having foreign investments, but we also believe in having domestic investments.
So I'm very interested in just one thing to chase.
Yeah.
Not a lot of things to chase. So if you do all the traditional things, even do it moderately your way.
Yeah.
But why can't sometimes I want to focus on one good thing. I've become an expert on the marijuana situation.
Yeah.
So, and I'm basing that on the laws that are changing.
Yeah.
So those are the kinds of things I think are important to look at, are things that have law and opening up markets. So what do we think about that in being one of the things that you can, it's too late to chase Apple, too late to chase, or even if it's a good idea, Amazon. So let's find something else and be forward thinking with laws. How is that?
Yeah. So that's a really good question. So this is what I would tell you.
Mm-hmm.
If you want to invest in something like that, I think it's awesome. I think you should, because if you're passionate about it and you want it, I
know. I mean, the law is changing, and I see, they're going to have these things that are put drops on cigarettes in the drugstore.
Yeah.
And there's just a lot of people that are going to do that.
Yeah.
I know that.
So we have a client right now that has a $35 million investment in marijuana facilities.
Oh, okay. I don't have that much.
No, but this is what I'm like.
Not that much.
Yeah, 34 million. But this is what I want to tell you this.
Okay.
So even with that kind of investment,
Yes.
they still don't know where everything's going right now. So the problem is what he has done is he has invested in 100 different companies within the marijuana field, because and this guy's a scientist, by the way, because he is unsure of which area is going to be successful. And he said the problem is it's very possible that 35 million becomes 10 million.
Okay.
But if he can afford to do that, that's great. But I would not take the risk not knowing what's going to be the next successor. I don't know what's going to be the next successor to the iPhone or to Apple.
Bitcoin.
No chance. I don't think so. I mean, but we just don't know enough yet. So there, if I was to take a flyer on something and say I wanted to invest in one thing, it would probably have to be something probably a little bit more established, or at least something that that's already on the public market. That's got a lot of. Some people are. I mean, it's hard to invest in things like that because it's like investing in penny stocks.
You got to be afford to take a loss.
You have to be willing to be able to just lose all your money.
Can't you say there's a percentage of money people invest in things that they
Less than 1%.
less than 1%? Okay, that's your number.
You know what?
You want to put
Maybe
5?
1.5.
Maybe 1.5.
1.5.
I'm saying treat it like gambling.
It is. It really is.
It all
I mean,
is.
yeah, I'm not a very good gambler. I'm not, but I do like to play craps and poker here and there. But I'm a tightwad, so it's not very much. But I go knowing that I'm probably going to lose my money. I walk in thinking I'm not, but I always know that the lights that they have on and everything they have, I'm like, this place is awesome. It's nice. Yeah. So
The house wins.
the house wins. It's set up that way. I mean, even at poker.
Is Bitcoin really a gamble?
Is Bitcoin really a gamble? I don't think that Bitcoin is real. Okay, and I will tell you this because there are other cryptocurrencies that are currently coming into the market now, and the more cryptocurrencies that come, it'll reduce the exposure to Bitcoin. I just don't Bitcoin. I mean, the algorithm won't work. Let's face it. The United States always plugs China for manipulating their currency, right? Okay, we manipulate our own currency here in the United States. If you don't know that, then it's just we do. Okay, but we like to yell about other people manipulating their currency. Okay. The truth is they can't manipulate Bitcoin. It will never become a currency. I mean, because if that was the case, we would all still be trading gold coins and silver coins to this day. Real gold and silver. That's something that's truly mineable, that does have value, and we could exchange. But that's why they took the dollar off the gold standard years ago.
When did they do that?
I think it was 1972. Does that sound right? Right now? I don't know. I think it was 1972. And since then, the U.S. dollar has flourished, and gold didn't do anything for a really long period of time.
Well, you say, why is Bitcoin not a currency? Because you can't buy the TV. If you want to buy a TV, right? You buy Bitcoin's based off of the dollars Bitcoin can buy.
But it's actually not. So because if it was truly based off the U.S. dollar, it wouldn't have appreciation against the dollar because the dollar doesn't depreciate as Bitcoin appreciates.
What I'm saying is, if this TV costs $1,000, you're going to have to buy it based off of what the Bitcoin is to the dollar, right? You're not going to buy it based on what the Bitcoin is.
I got more cowboy boots. I could buy 1,000 cowboy boots, and I could probably find somebody that would trade me that TV for 1,000 cowboy boots too.
Right.
But it doesn't mean my cowboy boots are currency.
Yeah.
Right?
Yeah, well, I agree. It's not. I don't think it's currency.
It's
buy
a
stuff based
computer
on the dollar.
program.
It's not a.
But for an investment standpoint, if you look at the Bitcoin prices over last 6 or 7 months, it has gone up from what, $2,000 to
6,000 or whatever. Yeah.
Right.
You know what? Tulips did also in the Netherlands in the 1600s.
Tulips.
Tulip bulbs. True. Look it up. Everything was the craze was the tulip bulbs. It was the Danish tulip bulbs, and they literally were selling for thousands per bulb because they thought, oh my gosh, there's only a limited supply. That fell apart too, and now I can go to Menards and buy tulips for cheap. It's no different. I mean,
that was 500 years ago.
Yeah, I know.
Sorry, you got
right.
one,
If somebody's willing to spend or pay money for Bitcoin, 6,000, 7,000, let's call it 42,000. So be it.
It's fun and exciting.
It is. It's fun and exciting. Okay. I just wouldn't
Entertainment. Entertainment.
It is. I wouldn't put a lot into it. So that would be my best advice on Bitcoin. What is a reasonable retirement budget as your lifestyle changes after retirement? Lots of questions about how much am I going to spend for health care and different things in retirement. So there's some different charts, and I'm sure Paul and his crew can hand these out to you. There are some different, at the age of 65 to 85, there is some different values and amounts that you will be spending on health care and retirement. A lot of the questions in here had to deal with health care and retirement. And actually here's another one too. Average household spending patterns by various ages. So just different things. Obviously, as you get older, you may or may not travel as much. Maybe your housing, your mortgage goes away or it shrinks. So these are actually some really good charts that are pretty self-explanatory. Let's go back to this one real quick. It really tells you how much the average person spends on healthcare. Healthcare in this country obviously is a big problem. It really is. I don't think they're ever going to rectify it. There's just people are just too divided on it, and so that is what that tells me is that healthcare costs are going to continue to escalate because until somebody gets a grip on them, it's interesting. They say everybody has the right to healthcare. Absolutely, they should. But not everybody maybe should have the right to health insurance because the health insurance companies are making a ton of money. So, I think that'll be the next area that probably falls apart with healthcare, but we'll see. So, this could be changing. Okay. Actually, that's something else. Questions?
Yes, I have a question regarding most
Bitcoin?
of no more Bitcoin. That's a gamble. Most of our clients who are business owners,
Yeah.
they have a retirement plan at work.
Yeah.
Let's say they have a 401k.
Yes.
And we advise them that you should also put money into an IRA.
Yep.
What should they do? Should they be doing that if they are already making above a certain limit, which doesn't allow them to put into a deductible IRA where they get a tax benefit?
Yeah, so the question is basically tax benefits and 401ks. Now, you guys are the CPAs, I mean, but this is what I would say is obviously invest in your 401k first. I mean, or your retirement at work. I mean, that's the best place to invest, especially if there's a match. But beyond that, you know, if you have the opportunity to do a non-deductible IRA and roll it into a Roth, but can you still do that? I mean, like the year, like December 31 to January 1. Huh?
It's tricky, but
Yeah. I mean, that's probably the next best investment. And then after that, it's probably, you know, tax efficient investing. Okay. Beyond that.
Go back to the original question. If you have $25,000 you want to invest, but you can only put in $6,500 to an IRA, what do you just do with the rest?
Well, you should still invest the same way. So if you're in your 6,500, your IRA, let's say you're a moderate investor, you come out moderate on the risk score, just for argument's sake. The other amounts of money you should still invest.
So what are the limits you can invest? There are no limits.
There are no limits.
Right. So that's one thing I think people, they think you have to just do what the IRA says you can do. You can do
Oh
whatever
no.
you want.
You can, if you have 150,000 in your checking, you can take 130,000 of it and invest it.
You just pay taxes on your earnings.
Yeah, that's right. Yeah, and that's why we should be tax efficient as much as we can, so the government doesn't get their paws on, you know, some of the earnings of our investments as much as we can.
Well, Chris was asking a question, but I've always, I mean, this is just such a $1,000 question. How is it, why is it that really wealthy people brag up, or why is it that they don't pay? How wealthy do you have to be not to pay taxes?
That's a poll question.
Yeah.
You know, we do tax returns.
Yeah.
So,
Oh, boy, don't
so
you?
we see, you know, what everybody. Some of the people that don't make much think people that make a lot don't pay.
Yes.
And some people think that wherever they are, they think the other people don't pay whatever they have a business. And they
Okay.
don't. It's absolutely not true. In addition, if you go into places where people have money or have, everything's straight because they don't take risks because they're in a good position and they don't want to. They report everything and do everything legal. They do pay a higher percent. The more money people make, they do pay a higher percentage because of graduated rates. So somebody that makes 0 to 100 pays significantly less than somebody that pays on the same dollars from 400 to 500. So one person paying 30%, one paying 50%. So every once in a while, you'll see a given situation, particularly where people are able to make it lower. But it's very much the minority.
They get more deductions though. I mean, for example, they have a bigger house.
They can be, but if you go back when Mitt Romney had a thing where he had a $2 million IRA, well, that's because he bought a stock, probably got a referral, and he bought a stock that was worth $6,000. He put $6,000 in his IRA, and it went up to $2 million. So yeah, he had $2 million IRA, but he started with $6,000. So how many people have access to that information? Not a lot of people, but when you see that, you might think people. So one of the things people that pay less tax is retirement plans, profit sharing plan, company profit sharing plan, or IRAs, or it grows in that vehicle, call it. It grows tax free, but somehow they get it. We have limits of what we can put in: 24,000 over 50 for 401k, and 6,500 and 5,000. But most of these people do it a little bit at a time. If you might see a situation where somebody has a $2 million retirement plan, it's because every month of their life they put in $150, $200. There's a bunch of little moves. It was just little, all along was just little moves. And even when something like, we've seen people that seem to have more that don't really make a lot. Because like an IRA, you have some people that, like April 15th, they're struggling to run over here to put the money in the IRA. Well, the person that has a lot, they put it in a year and 4 months, they put it in on January 2nd of that year before. So,
Yeah.
so they had, but they did that so most of the time, if you see somebody has money, it's because they did a lot of little things, not one big thing, generally speaking. But the people that have accumulated, other than retirement plans, they do pay, quote unquote, more tax. They don't not pay.
A lot of young people, I guess, we're often told the best thing to do is buy a house. I mean, start off early. When you retire, you'll have the mortgage paid off. My question is that really the best first large investment that a young person should consider?
Your first investment should be saving in your retirement plan. Period. That's what you should only be able to afford a house beyond after you're investing in your retirement.
Okay.
That's the advice my parents gave me, and I tell everybody that the same thing. I mean, when I was younger and I was getting married, and I was trying to figure out my budget and everything, and I was maxing my 401k out. Even when I worked at Ernst & Young, I was 22, 23 years old. I remember telling my dad, I'm like, hey, I'm gonna do this. He's like, as long as you can do it without not putting into your retirement.
Okay.
That's exactly what he told me, and that's what I tell everybody to this day. And it's good advice, because just like the first chart I showed you, consistent Chloe, who puts the money in at the start, she has a lot more money than nervous Noah or whoever.
Me.
So
So
I mean, it's just 25 to 65, and she's only investing $5,000 per year, and she's got $820,000, earning only 6% a year, at the end of retirement. But Lydia, who started at 35, right? I mean, she's way down here. Has half the money, just because she missed the first 10 years. And maybe those first 10 years, Lydia bought the house, right, and had the mortgage until they got to where they could do that.
Okay.
So
What do you advise about reverse mortgages?
I don't have any advice on reverse mortgages, to be quite honest with you. I know them, I know about them. I just don't have any advice on them. I mean, I don't know if they're good or not.
We see them as a last resort.
Yeah,
It's a last resort. It's not a bad. We've had people obtain them. It is something that is. If you don't have any other choices, then that can't be employed together. Yeah. But if you have there's other options, then not as much so.
So I see Nate Didier. But I need Nate Didier to start at age 55.
Okay. Yeah, so if you start.
That would be me.
Yeah, it's okay. Hey, no, I get it. So, depending on how much you make up here, and if you start, let's just say it's 50, okay?
I'll take that.
Okay, and you're going to earn 7% a year, and you want to live off $50,000, assuming you're going to pull out, I think it's 4% in retirement, and we had an inflation rate of 2.25%. I mean, you'd have to. It's 31 times 50,000, which is I think 1.5 million. If I did my math right, or 1.55, whatever. At the age of 50. So I mean, it's never too late. We're all living longer. I mean, it doesn't mean you're going to retire when you're 65. I probably will not. I enjoy what I do. I can't imagine retiring.
So part of that is, since we have older people and younger people here, though, if you do start later, that in some ways controls the risk, opposed to just your attitude toward risk. Because if you start at 50, you could work for another 20 years.
Yep.
That's a long time. Plus, you might need to be more risky because that's what you have. And as you were saying before, if you're 60 and have $50 million, do muni bonds, which are not going to get much. But I mean, so there's ways to do it. I mean, if you think of 20 years.
Well, there's absolutely ways to do it. Yeah, I mean, maybe you put kids through college, or who knows what, you had other expenditures. So, you just started late. Again, people are just living longer. So I would continue. It's never too late to start putting chunks of money away, ever. So
So what do you say the minimum should be that people contribute a year when they are in their 30s?
We say 10%.
10%.
I think you should always save at least 10% of your earnings. I mean, that's just me personally. I even tell my kids that today. I'm like, if they make money, if my daughter makes money babysitting, I make her put 10% away. Just put 10% away. She, yells at me usually, but I mean, it's like, she usually doesn't yell at me because she goes, I'll give her the flip phone.
So here's probably one question.
Go ahead.
I'm sorry.
No, you go ahead.
In general, is investing in annuities a good way to start investing in your retirement plan or outside retirement plan?
Yeah, I do not like annuities. Period. Zero. Because annuities are tax-deferred vehicles, and if you have an IRA or 401k, it's already a tax-deferred vehicle, so you're paying twice for the same feature.
Oh.
Yeah, I do not like annuities.
Plus.
Never have.
Plus the cost.
Well, yeah, that's what I'm saying. The costs are usually
Or the
exorbitant.
cost insures the balance.
Yeah.
But if you want to insure the balance, buy insurance.
Yeah, annuities are sold. They're never purchased.
Besides that, they have what's the average front end commission on an annuity?
7 to 8%.
7 to 8%.
Yeah. And trust me, they're getting that money from somebody, and it's coming out of your investments. It's inherent in the return. You
So
just
if you
don't.
put in
You don't see
100,000,
it.
if you put in 100,000, sales will receive 7,000.
Yeah, but you still have 100,000 invested, but it's just inherent in the return. They just don't
Sometimes
show you.
return
Yeah,
by the charge of 2% a year or something.
it's usually 2.5 to 3.5.
So they have 3.5 on your yield.
Yeah.
So if you get 7, they're going to give you 4.
Yeah.
And you're not going to see it.
Yeah, typically the insurance salesman will have you invest more aggressively than you think you are. So that way you're still getting sometimes you'll get a bigger return and you don't see the fees as much. But it's when things do poorly, that's when you start seeing everything. You know, if you're paying
The
attention.
salesmen argue that you can get the insurance and then invest more aggressively in that way. You can get a higher return.
Yeah, if you have an annuity, I would encourage you to look to see if it's a qualified IRA or not, and you might be able to roll it into an IRA and get out of it. And if you can't, and if it has a sales charge on it, the thing you do with an annuity is you can always pull 10% out of an annuity free without sales charge each and every year. So you take that 10% out every year and you invest it outside. You always set it up so you pull the 10% out every single year out of your annuity until it dwindles away and you get it out of the annuity period.
Unless you're lucky and it never dwindles and it just keeps growing.
Well, but you still
Right.
pull 10% out, and so you still save money.
Right. So it's not growing at 10%, but still is something going to be there if you keep pulling 10%.
Let's say it grew at 10%, you pulled 10% out,
Uh-huh.
and it stayed the same. That'd be awesome. But at least you're getting that. If you had 100,000, you get that 10,000 out and put into a true investment. Yeah.
So this is my naive question, but I was interested in your saying that as long as the government spends money, the markets will grow.
Yes.
So then why would we be so committed to tax efficient investment if we want the markets to grow? Wouldn't that mean on some level that the more we give to the government, the better it will do too?
You can't give that much to the government to make it do better.
Okay.
I mean, so
No.
you should always invest tax efficiently.
What does that mean? Tax.
That's what I was saying before. Apple, if Apple is worth $900 billion today, it was worth $700 billion literally 12 to 15 months ago.
You hold it, not sell it.
And yeah, you hold it and you don't sell it. So you invest your money and you don't sell. Just as a quick follow up to the how do wealthy not pay taxes and things like that. I will tell you this: the one thing that wealthy people do is they hire people to manage their money, and I would say one of the biggest reasons is people that manage their own money that we see, and I bet Paul sees this when he does tax returns, and you guys see this. People that manage their own money move from one investment to another because they're always chasing the latest fad. They're always chasing the last best thing, and day traders. It's a proven fact that only 4% of all day traders make money. 4%. Schwab's got the numbers. They did a big study on it about 2 years ago. They do not make money. It's just gambling.
You talk to them.
Well, yeah, if you go to the party, they're always telling you about their winners. They're never telling you about all their losers. And I guarantee you guys see it if you do taxes.
And the losers are those people that are, if I follow your analogy, the ones that are doing their own investments, chipping and jumping around.
That's right.
Okay.
Yeah, from one marijuana stock to the
No,
next.
But no, I really actually thought of 5. I hadn't thought of just one.
Yeah.
And I thought of about 2,500 or $5,000 and about 5.
There you go.
And I could, if I could close my eyes and let it go, but I just think one of them. I just really think.
If you're willing to part ways with that money,
Right.
yeah.
I just really think that
Or I tell you what,
Uh-huh.
you could take that money, invest it in investments that are already earning certain amounts of money, and I bet in 10 years you might be at the same place.
Okay.
It won't be as fun.
And I can sleep.
Yeah. So,
Very well.
Because of for excitement.
yeah, right.
You talked a lot about investing tax efficiently. Would that mean Berkshire Hathaway would be the best investment to make because they don't pay out dividends? It's all capital
I like
appreciation.
Berkshire. We own Berkshire in some of our investments that we manage, actually.
So if people who
I-
don't want to get hit with taxes every year in an investment, should they invest in that stock?
This is the problem. Warren Buffett's not a young chicken, and he is a smart guy. Don't always agree with everything he does, but he's a smart guy. But he's not, and Charlie Munger, his assistant, is, I think, older than him.
Yeah.
So I'm telling you, Berkshire Hathaway is going to have a rude awakening, probably. And I will tell you this: when Warren Buffett and Munger passes away, I will sell the stock.
They said that about Apple and Steve Jobs.
Yeah, but Steve Jobs was, he left more of a legacy, I believe. But I will tell you this: even Apple's gonna. They haven't been quite as innovative as they were when Steve Jobs ran Apple.
But they still look good.
Yeah, I still like
Did you read the story about the third guy that started Apple?
Yeah,
There were 3 guys.
yeah. The computer. He was more the programmer guy, right?
Yeah, he sold out after 3 months for $800.
Oh, jeez.
Is that true?
True. He owned 10%. He didn't think it was
I
good.
didn't like the long view.
He had a flip phone.
I think you should invest in flip phones now. I think they're going to come back.
Yeah.
People are gonna-
That's funny. Okay. Anything else?
Troy, could you explain how the financial advisors are paid and how does it affect us clients?
Yeah. So basically, when people invest with us, they typically pay up to 1% based on how much they have in assets, and we charge quarterly on that. So it's like 0.25% per quarter, basically. If you're 500,000 or under, right, in investments, and so then we diversify your investments and try to find what we think are the best investments that meets your risk tolerance.
She's asking, how are all financial advisors and how they're paid affect the way they manage?
Yeah. Okay. So that's how we do it.
That's how you do it.
Yeah. Some charge commissions. So some charge like 5% up front. When you put $100 in, 95 gets invested. So is that what you're asking me?
Other people that sell annuities,
There's people sell annuities, the commissions. There's a lot of different
people that sell.
sale.
It makes a difference how they're paid
It
and
does.
how they invest. What breaks that?
Arguably, I think we're one of the probably less expensive groups.
Because you're from Indiana.
Well,
Yeah.
our rent, in our nice building is, $17 a square foot. Out here, it's like 45. So, generally speaking, I'd say, we're very competitive, but that's how we make money. That's how most advisors make money.
when you take over someone's account, to get it in line, don't they end up having to sell what they have, and then wouldn't that give them a huge tax bill?
Unfortunately, sometimes it does, and sometimes it doesn't. Depending on what their basis is in it. Number one, if it's in an IRA, and we move everything, there's no tax. So we're obviously we're not worried about. We do look at that actually, and we've looked at portfolios where we say, hey, we can work with this on this portfolio, and we're going to move this and this around, or we take time to adjust it so we don't have a big tax bill all at once, or we can find something that fits into our portfolio. So we do look at those things. You know, if somebody has a big tax bill, and in fact, there's been times that we've looked at portfolios where it's been too big, where we say, hey, look, it's probably just not a good fit. You probably just need to, you know, take the dividends and interest that you're earning and capital gains each year that you would already pay taxes on, and just invest that, and
not sell anything.
And not
So
sell.
it depends on the person's attitude. If they just inherited this big stock that they don't have any attachment to, or maybe they do have attachment to.
Then they'd have
You
a
know,
stepped-up basis.
But or not even inherited it, you know, you got it from work or whatever the case may be. And then, or maybe they've had something for 20 years and, you know, you've got $1 million and that's, you only have $1 million stock and that's all you have. And then you're worried that it's going to go down 60%.
Yes,
So it depends on your attitude whether or not you want to pay the tax bill or not. We'll talk to people about that.
it does, but I mean, you just have to be careful of that. I mean,
Yeah.
we had a person actually that had $1 million of AT&T stock the other day, and their basis was very low. But we told them, we said, really, you know, you probably need to slowly diversify out of that. I mean, General Electric. I mean, you know, there's been a lot of companies that have really faltered over time, you know, and so I mean, if you have one stock, it's just something you have to look at each portfolio independently.
What are the pros and cons of having, for example, I came into this with I've used Vanguard a lot in my private practice, but then I invested in you all. So what's the pro and con of keeping both going versus consolidating under one roof?
Okay, so this is my sales pitch.
Yeah.
Right, but I mean, by having it all under one roof, I mean, you can have an advisor that helps to understand the whole picture. When I was a CPA, I'm still a CPA, but when I was a CPA years and years ago, the hardest part is people would ask you questions about tax planning and so on. But if you didn't have the whole picture, it was very difficult to say, okay, well, you know, this is going to be this, and it was just so much simpler to have it all together and say, you know, this is what the whole picture looks like. This is my best advice for you. You know, I mean, that's a biased opinion, but it really is kind of how